Sounds good. I did a podcast a couple of weeks ago, and we went 45 minutes straight and then forgot to record it.
Yeah, that sucks. It always sucks.
All
Everyone,
right.
thanks for joining us here. So especially around this election time, it's it means a lot to us. So we have Travis Watts here. So he's a passive investor in real estate, and he's also head of investor relations at Ashcroft Capital. He would though speak about his personal experiences investing as a limited partner in various syndications. So I'm really excited to hear what he has to say today. With that, I'm passing on to the Travis.
Awesome. Thank you so much. I appreciate the invite. Thank you, everybody, for being here. If you're here live, if you're watching the recording, you should have been here live because it was a lot better. So I'm setting a timer real quick for about 25 minutes. That's what I hope this presentation will be, 25 to 30, and then we'll bounce into a quick Q&A. And if anyone wants to follow up in more depth or detail, I'll give you a link to do that at the end. So let's get started. So our topic is real estate private placements or apartment syndications or multifamily syndications. Both terms are to an extent. I'm Travis Watts. I'm a full-time passive investor. Didn't start that way. I'll get into my background here in just a minute. And yeah, we were just talking before the call that before COVID, I really wasn't online too much, but I've launched into Instagram, Facebook, BiggerPockets, LinkedIn. I'm all over the place now. So feel free to reach out on any of these networks if you have any questions or if I can be a resource to you in any way. I'll give you some more links at the end. So with that, let's see if I can get this. A couple of disclaimers. This whole presentation is not financial planning or financial advice. We're not going to talk about any deals or investing. These are just my viewpoints, my opinions as a limited partner, as a passive investor. I'm just bringing this educational content to you guys with nothing to sell you. Not a lawyer, CPA, or any of that good stuff. So this is just, chatting about investing among peers, so to speak. So a little background, excuse my cheesy graphics here, me in the photo shoot doing all the pointing, but as I said, I'm a full-time investor, director of investor relations at Ashcroft Capital. Ashcroft Capital's a nationwide syndication group co-founded by Joe Fairless. If any of you are familiar with the Best Ever brand or Joe's podcast or the Best Ever conferences he puts on, that's all under that umbrella with Ashcroft Capital. So I started in active investing. I was a very active, hands-on, doing everything myself in the single family space of real estate. I got started in 2009 doing that. I did everything from house hacking to flipping houses to vacation rentals, doing the BRRRR strategy and buy, refinance, rehab, repeat, that kind of stuff, until I got to 2015. So I gave that about 6 years, about 5.5. And I had an oil field job that I was working 98 hours a week, 14-hour work days, out of state, out of country. I was working in Saudi Arabia and Kuwait. It was just a lot for me to handle and to manage. And I got to thinking, I wonder how many other people out there are busy, professionals, busy in their career, don't have the time to be doing everything themselves. How are they investing in real estate? What kind of partnerships are there? How does that exist? What about these gurus, these Robert Kiyosaki's out there? What are they doing? So this is where I discovered private placement investing and syndications and how to be a passive, hands-off investor. So that brought me to 2015. I was kind of like my breakthrough year into that new way of investing. I sold all of my single family homes, including the house that I lived in. And I went into just one deal after the next. I've done, 30 something deals as a limited partner where I'm investing some capital alongside groups who are actually managing the projects and doing all the legwork, so to speak. So that's about 11 years in real estate overall. I just have a passion for helping people understand real estate investing, no matter what type of real estate we're talking about. I see huge benefits to all different types and models. And so, yes, I'm an advocate for passive investing, which is what we're talking about today primarily, but I'm just an advocate for real estate, the tax advantages, the leverage, the cash flow, and the financial independence that it can create and has created for myself. So here's the agenda I've put together. I want to talk a little about a term called time freedom. This is something I speak to a lot on the personal side through a lot of my outlets. I want to go into what that means, how that works. I want to talk about active versus passive investing, as I alluded to in my backstory a couple of minutes ago, and then single family versus multifamily, kind of the pros and the cons, giving as much of an unbiased opinion of the two, since I have immersed myself almost equally in both sides of that equation. How to vet an operator and or a syndication. We'll talk a little bit about markets and things like that. I do have some giveaways at the end if you want to go much deeper into this. Nothing is for sale. It's all for free. So stay till the end and I'll give you a link to that. And then I'll go over my personal wealth strategy, kind of what I did. Like in reality, I know a lot of educational content out there is a lot of high level fluff. And then you're kind of left at the end thinking, yeah, but what do I actually do? I want to give you some of those practical steps that you can take. So let's dive right into it just to stay on time here. What is time freedom? I define time freedom as the ability to do what you want, when you want, as much as you want with your time. I think all of us, if we're truthful with ourselves, at the end of the day, we just want to have that type of freedom over our time, maybe now, maybe just eventually. And what I mean specifically is, if you didn't have to work for money, okay, what would you do with your time then? Well, some people would volunteer, be more charitable, volunteer perhaps at a church or something like that. Others, maybe just some time to yourself, some self-reflection, maybe just removing yourself out of the so-called rat race or the corporate world for a while or indefinitely. I myself and my wife, we love traveling. We were worldwide travelers before COVID. We'll see what happens in 2021, but spending time with friends and traveling, obviously spending time with family and with kids, top of the list for a lot of people, and or just retirement one day, right? I mean, at some point, we can't all be flipping houses into our 80s and 90s, right? You got to somehow get passive one day. So why not learn it sooner than later is kind of my philosophy on that. So how do you create time freedom? Let's get a little more practical into the how-to. So again, my definition of this is when your passive income exceeds your lifestyle expenses, then you're financially free or financially independent or quote unquote, you have time freedom. So two key components here. Passive income, money that you're not having to exchange your time and effort and labor for. This is like investment income, portfolio income. Lifestyle expenses, I mean, your rent, your mortgage, your utilities, cell phone, food, travel, vacation, all that good stuff, right? To live your life the way you want to live it, you have more passive income than what's needed to live that lifestyle. So here's just a simple example, simplest one I could come up with. Say you want $100,000 per year in passive income. So if you were to invest $1.25 million at an 8% annualized return, that would give you $100,000 per year. Why 8%? Well, again, I'm not a financial advisor. This isn't a guarantee or promise of any particular type of investment. What this is about is looking back at my portfolio from 2009 through today and looking at my average real estate cash flow returns. And I just came up with a number, 8%. I feel like that's a somewhat conservative and achievable and a realistic number. Some of my deals, for full transparency, they cash flow lower. I've got a couple deals that are only cash flowing at like 4% a year. I've got others cash flowing at almost 20% a year. So I'm trying to find a happy medium there in terms of a diversified portfolio. That's just a simple example to paint a picture of what that might look like. If you want to go by the traditional Wall Street 4% rule, obviously you double that number. So you say 2.5 million invested at 4% equals 100,000 a year. So you run the numbers for yourself. I'm not advocating this should be your number. This was pretty close to the number I came up with years ago when I went to the passive route to try to figure out what financial independence would mean for me in my scenario. So moving on to active and passive investing, let's define these a little more. So active obviously is hands-on. This is how I started with real estate. This could mean fix and flips, vacation rentals. This could mean wholesaling properties, or this could mean you're a general partner in a syndication. You're the one running the show, finding the deal, doing the underwriting, raising the capital. It's a very active job role to have. These are all real estate examples, by the way. To be a passive real estate investor, you're hands off. So maybe you're the limited partner in a syndication. That's what I do full time. Maybe you're investing in REITs, real estate investment trusts. A lot of those are publicly traded. Some of those are private. Note lending or being like a hard money lender, high dividend yield stocks, tax liens. These are all investment vehicles that yield cash flow or interest or dividends, things like that. That don't require your physical labor and time and efforts. Quick note on this. I forgot I put this in here. This is so Theo Hicks and I, under Joe's brand, the Best Ever brand, we just launched a show called the Actively Passive podcast. It's a YouTube show, just launched a few months ago. And we go into a lot more detail on each of these topics of what it means to be active and to be passive, and some self-awareness and exercises to go through. We talk about all kinds of stuff. Quite frankly, we don't stay on topic a lot of times. And we'll end up talking about stoicism and ancient philosophy, or how celery juice can help you, be healthier. It's just crazy stuff. But anyway, check that out if you get a chance. All right, let's jump into single family pros and cons. I'll start with the pros from my perspective, my experience. So usually you have a lot of control. You're finding the deal, you're finding the property, you're deciding what you want to do your way, you're painting the walls the color you want, you're putting carpet in, or hiring that stuff out. But you have a lot of decision-making rights, so to speak. It's usually local. That could be a pro in the sense that you can go drive by that property and it's nearby. A lot of the investments I have are out of state, so it's not always practical to go visit them. Potentially higher returns. I say potentially because I've certainly done passive deals that yielded more than some of my active deals, but I've certainly had active deals yield a lot more than my passive deals. So potentially, if you're putting in the work and the labor, I would higher return out of that for doing, spending your time doing so. As we talked about, you could buy a house and live in it and then fix it up and then later convert it to a vacation rental and then later switch the model to a long-term rental. There's a lot of creative outlets you can do with single family and changing those strategies. Now on the con side, it requires your time. How much time do you have in a given day, week, month, year? I don't know. For me, I didn't have a lot, so as I started scaling up a single family portfolio, it got harder and harder and harder and harder to manage, even with property managers, to the point that I naively had this goal of, 50 or 100 single family homes one day. I wasn't even hardly 20% of the way there, and I'm giving up on it because it took too much time. So something to think about, whether you have 1, 2, 3, 4, there's going to probably that you think, hey, this is kind of becoming a job. Hey, you just have to be aware that that's going to happen. So to that point, it's hard to scale. What I mean by scale is have a hunting be a full-time job. Recourse loans means that, you're going to the bank and you're saying, look, here's your income line. So if things go bad, that lending institution's coming after you. Whatever you owe them, not always a great thing on single family investors are all buying in, say a 100-mile radius, give or take. It depends, obviously that's a generalization, but in my case, I invested out in Colorado from Fort Collins to Denver, which was about a 65-mile radius. I had all my properties up and down the Front Range of Colorado. That's not a lot of diversification. What if Colorado decides to quadruple their property tax? You have a lot of risk on natural disaster. What if we have a horrible year for flooding or for tornadoes coming through? I didn't have adequate diversification, in my opinion. So that didn't sit well with me. And the value of a single family home is based on comps, comparable sales of other properties. This is what was kind of the downfall of single family in 2008, 2009, 2010, is we had massive foreclosures and short sales happening. And even if you had a great property in a great neighborhood with a great renter paying rent on time, in full, above market value, didn't matter about the value of that home, because if all your neighbors had foreclosures and short sales, the value of your home went down. And that's just how it is. That's how they're valued by appraisers and lenders. So let's talk about multifamily now in comparison. Let's start with the pros. It's a hands-off and passive approach, speaking again as a limited partner, not a general partner. Scalable. Hey, I could do one deal. I could do 1,000 deals. My workload is put in up front, vetting the deal, the sponsor, the market, making a decision, wiring funds, I'm done. And now for 3 to 7 years, typically on average, I'm hands off with that. And I'm going to let that flow collect cash flow that's going to be sent directly to me, usually, direct deposit, ACH, stuff like that. So it's a lot easier to have 100 deals passively in syndications than it is 100 single family homes. I get to leverage other people. This was a huge thing for me. I had to get real with myself at some point when I was in the single family stuff and say, is this really my highest and best skill set? Am I really made for this fix and flip stuff? And the answer is hell no. Quite frankly, I am not handy. I do not have any connections. I did not have any connections back then to contractors or to people to help me. It was a horrible experience because I was no shining star in this industry, and quite frankly, I was probably like one of the most amateur people doing this stuff. And I got lucky because, the market was doing well. And yes, I underwrote decently and, I made a profit and things, but it just wasn't my thing. Quite frankly, it wasn't my highest and best skill set. So I get to leverage other people in multifamily that are experts, true experts who are passionate about what they do, best in class at what they do, both from an operator standpoint, property management standpoint, CPAs, lawyers, the whole deal. I get to leverage the best of the best. And I love that personally. Diversification. I've got properties and I don't even know how many states, and that's a great thing. I love to invest in a lot of different areas. Some people say I've got some Florida properties, and some people say, well, I don't like Florida because of hurricanes. Well, fine. I've got some Texas properties. Well, I don't like Texas because of whatever. Okay. Well, I have some Colorado properties, so it's nice just to have that and to be able to put 25K or 50K increments here and there in different deals nationwide across the board. And the valuation is based off the net operating income. That's probably the single biggest difference between single family and multifamily. Multifamily properties, you take like a 400 unit apartment building, that is treated like a business. Your net operating income after you pay for your operating expenses and management to run that property, it's selling at a multiple of the net operating income. So as long as you can keep rents up and collections up, occupancy up, things like that, as long as people are continually living there and wanting to live there, you have a whole different valuation system. Yes, a portion is based off comps, but the problem with comps with multifamily is there may not be any comps. You may not have another 400 unit complex for 100 miles, maybe. So it's really hard to base things off of comps. Plus, no property is really the same. You don't see a bunch of, cookie cutter multifamily like that typically. All right, into the cons. No direct control. You, as a limited partner, as a passive investor, I am relinquishing control and decision-making rights, usually voting rights too. It just kind of depends on the deal, for diversification. So, that could be a con. If you like to call the shots and you think you can do it best and all these things, this may not be the right asset for you, the right approach to investing. It's usually not local. I say that I've got some Florida, some Colorado properties, but most are not in states that I live in. So again, I have visited a number of my properties, not all of them, but it's not always practical. Sometimes you have to be an accredited investor, a high income, high net worth individual to participate in these syndications. $1 million net worth, whether you're single or married, 200,000 for the last couple of years in income is another way to qualify as an individual. with the expectations of doing the same in the current year, or 300,000 as a married couple for the last 2 years and expectations of doing the same in the current year. So it's net worth or it's income. There's the SEC just redefined the definition of an accredited investor. Now some folks with some licensing, Series 65, Series 7, for example, you can be deemed an accredited investor that way. So again, look into it. I'm not an expert on it, but just know that, roughly 50% of the groups out there are doing accredited investor only opportunities of what we're talking about. The other half, you can be what's called a sophisticated investor. You do not have to be accredited. You just have to understand the deal and the risks and that it's illiquid and just what it is, the ins and outs. And then if they're doing a 506B offering, I'm not going to get into that. You could potentially participate in that deal. So don't be scurried off if you're non-accredited. There are opportunities with numerous groups out there. If you are accredited, the world is your oyster, so to speak. These are illiquid investments. This is not a stock. This is not something where you say, here's 50K on this deal. And then 5 months later say, you know what, I actually need that 50K back. You can't get it back. You can have somebody buy your shares potentially. There's different things that can be done. It's a slow process. It's not a guarantee. There's no public market for these. These are private placements. They're private investments that you're investing in. Usually requires a relationship to invest, depends on the type of offering. And I only say that as a con. I think that's a pro. You should have a relationship with somebody that you're going to put that much money with. But if you're not a people person, if you're not into like networking and connecting with a bunch of people and getting on their deal list, just think about that because you're probably going to have to do that. All right. How to vet an operator and a sponsor. See where we're at on time here. Yeah, I'm running a little behind, but I'll bounce through these here. These are just some ideas. This is coming, again, my perspective, my opinion. There's tons more. You may agree or disagree on some of these, but I ask these typically to a new sponsor I'm working with or general partner. How do you handle key person risk? What that means is if there's one general partner who's putting this whole thing together, what happens if they pass away? You need to know what happens. Who's going to take their place? Is someone going to take their place? Have they not even thought this through? Do they have key man insurance policy on them? It's not a right or wrong answer. It's just knowing that they have a plan, basically. Cool. What is the break-even occupancy? I look more heavily at this here in 2020, given COVID. It's basically if you have a 100-unit apartment complex and your break-even occupancy is 65%, that means that 35% of your tenants can either not be paying rent or those units can be completely vacant and you're still not losing money. You're breaking even on your operational expense and paying your mortgage and things like that. So that's a key metric to look for. In my opinion, something I always ask for. It's not always in the overviews and pro formas, unless it's really low. They like to highlight that. What is the exit cap rate compared to the entry cap rate? Make up a cap rate. If we're buying an apartment at a 5 cap today, and it's a 5-year hold plan, a business model, I want to see at least a 5.5 exit cap rate, maybe even a 6. And what that means in layman's terms is that you're predicting that the market in the future could soften. Therefore, the purchase price could be lower than what you hope it's going to be. And so the returns that you're looking at are based off a conservative assumption. And that's the whole point. You don't actually want a higher cap rate when you sell. You just want to know that they've thought that it might actually be that kind of market down the road. They're not thinking best case scenario. What is the track record of the company or the GPs involved? Hey, there's a lot of new companies that come out. That's not to say don't invest with them because they're new. Sometimes those general partners come together and have 30 years experience, so you got to look at kind of the and/or situation there and choose what you feel comfortable with. Does the sponsor do the same type of business plan consistently? Again, this is part of my criteria. I like to know I'm working with a group that's an expert and a specialist in a very particular niche. They do 200 to 600 units and Dallas, Fort Worth. They do value add business plans only. They focus on the B class sector and they do the same 10 things over and over. That's what I like. Again, take it for what it is. You may not agree with that one. Do GPs invest in their own deals? How much are they investing? So it's typical that the person putting the deal together, the sponsor, the general partner, is putting their own personal capital into the investment as well. And that's going to be under the same terms that you would have. And so if that deal goes south, their money goes south too with that LP ownership. So you would just want to know how much, that's a big one. A lot of GPs will say, yeah, we're investing in this deal. But how much? $5,000? Not good enough. Not good enough for me. 100,000. Okay, now we're talking. I've seen some put in $1 million into a deal. So obviously, having skin in the game is important and a beautiful thing about syndications. All right, number 6. We talked about cap rate. Sorry about that. That's a repeat. What are the projected returns? Are they gross or net? I've seen this sometimes in an overview. They're showing project level potential returns, meaning the deal itself is, we're going to buy this deal at 10 million. We're going to sell it at 15. There's this big $5 million profit. Yeah, but what are you going to get as the limited partner after the fees and the splits and the commissions? Maybe you're not getting anywhere near that amount. So it's important to know if they're talking gross or net on their projections. What are the fees? No right and wrong answer to this. Just be aware of one, that there are fees, and two, what they are, and just be comfortable with it. If you're uncomfortable with it, or you feel like they're taking a abnormally large portion of the deal, maybe pass on that deal. I don't know. Maybe don't work with that operator, but you typically have an acquisition fee for finding the deal up front. That's usually paid to the general partnership at closing for doing the deals and all the due diligence and the paperwork and the legalities and all that. You've got an asset management fee for making sure that, so that's my timer, I'm going to speed it up a little bit. Asset management fee, making sure that that the business plan is being taken care of according to plan with the property managers and the contractors. Then you have a disposition fee usually, or a split on the equity on the back end. If you do sell at that $5 million profit that we talked about, that they're getting a portion of that. So just be aware. Can they provide a prospectus or a company overview? This is just a certain basic level of professionalism. Who's your company? What's your mission statement? What are you guys about? Any past history? Like, show me some kind of brochure or something, a website. If they can't provide you with that, it could be a red flag, which we'll get into in a minute. And what type of debt structure are they using? I like longer term debt than what the business plan is. If I'm going to go into a deal and it's supposed to take 5 years, I want to see at least a 10-year debt term, so that in 5 years it rolls around and we're in a horrible market. We're in the next Great Depression. I don't want to be forced to refinance or sell at a bad time when the equity may not be there on the project. That 10-year term gives us another 5 years to hold the asset for the cash flow and figure out how we're going to handle the situation longer term. So that's important. I'm not a big fan of short-term debt, bridge loans, adjustable rates if you're not buying interest rate caps, all that good stuff. So again, all this is high level here. We can go into, oh, geez, I forgot about this slide. More details at the end. So that Christopher Lloyd and Dennis the Menace, anyone who forgot what movie that's from. Red flags. So not having a PPM, a private placement memorandum, is a huge red flag. That's just a legality that goes along with these private placements and these syndications. There should virtually in all cases, there should be a PPM. Ask to see it, definitely review it when you get it. That's part of the process of investing. No prospectus or company overview. Again, we talked about that. They should have something professional to show you about their company. No track record could be a red flag. Again, do the general partners have a track record elsewhere? What have they done historically? If they're just starting out, brand new, first deal, I'm probably not going to invest myself, but you might if you know the person, who knows. No GP co-investment. Why not? Do you not like the deal? Do you not have the money? What's the reason for not investing in the deal that you're telling everybody else is potentially a great deal? Buying into an existing LLC. Wow. Whew. One of my first deals I invested in years ago in a syndication, we bought an existing LLC that had already held the property. We just took it over instead of forming a new LLC to buy the property, okay, and then relinquishing the old one. The problem was, unknown to us, there was ongoing litigation that we became the proud owners of as we closed on that deal. And that litigation just flowed right up through us, and we had no idea what had happened months previously. And so bad deal, really, really bad deal. So make sure that the general partner is creating a new structure. And last but not least, the gut check. If you see that guy hanging out around a tree asking you for $100,000 to invest in his deal, think twice. Just use a gut check. So All right, we're getting to the end here. My 4-step strategy. These are the things I implemented from 2009 to 2015 the most, and I still implement to an extent today that have helped me get on the path of being a full-time LP if anyone has that interest or just wants to move that general direction. Number one has been earning as much income as you can using your highest and best. Doctor, dentist, lawyer, attorney, what you went to school for, side hustles. I flipped real estate. I worked in the oil field, as I mentioned. I did all kinds of things just to try to get my income up, basically, okay? And then I lived on as little of that income as possible. I put in there 5 to 10 years as a general time frame. I had a huge savings rate. I don't even know what it varied, obviously, but 50% plus I was saving of my take-home income, and I was putting all of that into real estate, you know? So ideally assets that produce a combination of cash flow and equity upside potential, which we didn't even get to in the beginning of this presentation when I talked about 8%. I wasn't even talking about the equity potential of things going up in value and forcing appreciation. Hopefully your returns would be higher, but not a guarantee or promise. And avoiding bad debt, credit cards, car loans, you know, personal loans, stuff like that. Pay off the highest percentage first, just general Dave Ramsey advice, Susie Orman, whatever. But, you know, if you have all this debt and that you're looking at and you got a 20% a year interest rate on your credit card and 3% on your student loans, perhaps pay off that credit card first, right? And then move to the student loans or the mortgage or the car loan or what have you. So really that's it. I know that looks simple and it's easy to look at on paper. That was not super simple to achieve in real life, but that's what I did. And so that allowed me to have enough seed capital to invest, to build enough passive income to replace lifestyle expenses. So final thoughts, Tony Robbins. Most people overestimate what they can accomplish in 1 year, but they underestimate what they can achieve in a decade. I love this quote. Couldn't be more true in my story. And it's true in so many different stories. So set realistic goals. Sometimes I'm speaking to an investor that says, you know, I want 20,000 a month passive income. And I say, okay, great. What's your time frame? 1 year. Okay, great. What do you do for a living? Well, I don't have a job yet. Okay. show me your trust. You know, it might be a little bit tough. So just be a realist, you know, 5, 10 years, maybe more, maybe 15, 20 years, but start the journey would be my encouragement on this path of building up some passive income streams. I have a PDF guide. It goes into a lot more detail. It's not any kind of upsell. It's just basically how to vet a deal, a sponsor, a market, industry terminology. It's only 20 pages, by the way. I'm not giving you this chapter book to read. If you want that and or a 15-minute Q&A call, which I do for anybody who wants a more personalized Q&A, we can do the Q&A here in just a couple minutes. But anybody who has like, hey, this is my situation, my circumstance, I had a question about this particular thing, you may not want to share. I'll give you the link verbally. I didn't put it on here for some reason. It's www.ashcroftcapital.com/connect with Travis. ashcroftcapital.com/connect with Travis. You can get the PDF guide and or set up a call. If you don't want to set up a call, my feelings aren't hurt. I get it. I'm just here to be a resource and help. I'm not here to upsell anybody. So as I mentioned earlier, Bigger Pockets, LinkedIn, YouTube, the Actively Passive Show, Facebook, Instagram. Find me, reach out if I can help you in any way. I truly, sincerely mean that. I just try to be a resource on the active, the passive, the syndication, anything you guys have questions on. So that's my presentation. We went a little bit long, but I guess we'll open it for any Q&A. And yeah, we'll take it from there. Appreciate everybody's time. Thank you again for tuning in.
Awesome. Thank you so much, Charles. That was really, really good. Actually, it's so informative. I learned a lot myself. And yeah, so if you guys have any questions, feel free to put them on the chat or just speak up. And yeah, if you do put them on the chat, I'm going to relay them over. And maybe I will start. So do you have actually, when picking private placement, do you have a criterion? I know you mentioned like actually really interesting criteria, for example, the exit cap rate versus the entry cap rate and things like that. Yeah. But do you have a criterion in terms of, let's say, forced appreciation or value add that the sponsor is targeting? And yeah, do you have like a target IRR? Like what are your usual usual metrics, profitability metrics that you look at?
Yeah, it's a great question. I usually don't publish that stuff publicly because I'm a big advocate for everybody defining their own criteria based on, your own individual needs, wants, goals. And just because I have, 20 line items of what I think is important doesn't really mean anything to you or anyone else. But I will share some of these just to give examples. So what I invest in primarily are B-class assets built in the 1980s, 1990s, early 2000s with a value add business plan. So we're going to go in, rehab the units, rehab the landscaping, put in perhaps a new property manager, maybe even rebrand the asset to get rid of any negative old connotations with that particular apartment building. And we're just going to build it back strong, bring back occupancy if it's been low, push the market rents to ideally just below market level. But when we're purchasing, we're probably a couple $100 per door below the market as it stands today. So that's kind of the sector I look at. I like monthly distributions, monthly reporting, teams with experience and track record. Break even occupancies that are very conservative. This year one projections that are very conservative. I'm okay with getting less cash flow in 2020 and 2021, knowing what's going on. I'm not going to just look for the deal with the highest potential return because that's probably aggressive on the underwriting unless somebody found an incredible deal that nobody else out there ever saw. So, those are just a few things to think about. There's A-class apartments, new build, new construction, luxury, the downtown Manhattan, San Francisco. There's all that kind of stuff. There's B-class value add. There's C-class value add. That's usually like 1970s, 1960s products, sometimes 1980s. And a little tougher to manage and things like that. And so I don't really mess with anything below C. And there's a lot of different things, self-storage, mobile home parks. I could go on, but it's just looking at all of this objectively from a high level and then deciding, there's something I like about this concept or this business plan or this asset or this particular state or this particular submarket. So define it for yourself, but it is important to have a list of criteria so that you can find operators doing what it is you're looking for.
Sounds good. Okay, so we have a question on the chat from Hendrik. So do you ever evaluate the size of the syndicate? And when you started out, did you follow other LPs given your perhaps limited experience?
Yeah, it's kind of funny. When I made several mistakes when I first started. One was vetting the deal too heavily and not vetting the sponsor team. And to me, what I learned very quickly over just about 24 months was the team should really be what you're vetting the most, and the deals really last. So to me, it goes the team, the general partnership, then the market and the sub-market, reasons to be investing in that particular area at this particular time. And then it's the deal with the idea that you put the first two in place and the third kind of falls in line, so to speak. But of course, I'm still vetting the deals as we just talked about. But yes, I reached out eventually, to answer your question, to limited partners in the industry that are now like myself today. And man, I should have done that from day one because the biggest impact that I've had on personal development and quote unquote, success has been from mentors. It's been from finding people who are successful at doing what it is I wanted to do and then leveraging them, picking their brain, taking them out to lunch, whatever it was, paying for consulting. It was worth every penny I've ever spent on that stuff. And it's the big, we can read books all day and they're great and I'm not down on them, but hey, at the end of the book, guess what happens? You close it and you go, yeah, but it's 2020 and it's an election year. And what about COVID? And what about, and then, it's just better to have a mentor. So yes, to answer your question.
Well, quick question here. So I'm speaking audio here. Do you have the possibility, I know this could be done, but 1031 exchanges into a syndication? I guess you had to create a tick structure for that. Do you have operators that are willing to do that?
That's a great question. So a 1031 is basically a tax deferral strategy where you can roll your proceeds from one project to the next, on and on again. It's kind of more of for a lot of people, I should say, it's an estate planning tool. So you're kicking the can on paying the taxes over and over and over again. And then let's say one day you pass away and somebody inherits the property, they get the current basis level or market value, so they don't owe the back tax on it. So if that was too complicated to answer your question, yes, some syndicators and some general partnerships allow 1031s on the front end, but this is the tricky part. The front end's the tricky part. So if you're going to go sell a bunch of single family homes and then pull that money into a syndication, usually either the operator isn't going to allow it, or it's going to be a very, very high minimum investment. We're talking like in the millions, and I could name 6, 7 operators that have that criteria. Now, when you go into a syndication, let's say I put 50,000 into a deal and in 5 years it sells, and now I have whatever, $100,000. A lot of operators now are offering 1031s on the back end if you go into their next offering. And like Ashcroft Capital is one of those groups that does that. But you got to stick with that operator. And my personal take on this is, it's much harder to do 1031s in the syndication space than it is the individual purchasing space. If you're buying your own properties, whether they're single family or multifamily, it's far more easier. You have a lot of options to roll into. When you're working with a syndicate group, what if in 5 years, I don't like the next deal coming up? I don't want to invest in it. Well, again, I could go through another third-party group, but they're going to say, oh, it's a $3 million minimum. Well, that may stop me from doing it. Or I'm forced to go into a deal I'm really not happy with and don't really want to invest in. And I think that's always a bad idea. So the point is, yes, it's a possibility. Is it tricky? Yes. To me, the odds just seem like I might be successful once, twice, 3 times, but there's going to come a day that it's like, all right, this isn't going to work anymore, and I'm still alive. So for what that's worth, hopefully that helps.
Yeah, definitely.
I think Jason, you have a question. Yeah, go ahead.
Yeah, hi. Yeah, I have a quick question. Because when I'm raising money for the different deals that I'm part of, like I like to go into it with operators, that might have more experience, especially depending on the size of the deal. But I find that when I'm talking to investors about different operators, that I have to go ahead and explain what an operator is. What are some examples that you have, best ways, like in a nutshell, to explain the difference between an operator and a syndicator or a person who's raising the capital?
Sure. So just to make sure I understand your question. So you're talking about the specific difference between somebody who's operating the property versus raising capital for the syndication, like just kind of the inner workings of a syndicate?
Exactly, because one of the things that I mainly do, my main function is to go out and raise the capital for the different deals I'm putting together. And then I'll go ahead and I'll partner with an operator. And as I'm explaining it, it's like, I feel like maybe that operator, like a lot of different companies or organizations, can fall under the umbrella of an operator. And so, I mean, at least that's where that's a little bit of the headache the hiccup that I'm coming up against. So I want to know, what was your opinion? Like when you say operator, when you talking to people about operator, like how do you explain it?
Yeah, that's a great point. So there's all kinds of different structures. This presentation obviously is kind of a high level overview, but to your point, you could have co-sponsors, people raising capital for other deals. You could have co-GPs. So you have kind of the primary 1 or 2 GPs under their umbrella of a company. And then you have kind of a co-GP, somebody who's third party that is affiliating and helping raise capital for that particular deal. The best way is, for me anyway, the best explanation I can provide to people is a visual representation to show who does what and the inner workings. That's usually in our legal docs anyway. If it's not there, you can just find a generic one, or I can email you one if you want it. And it's just the generic, GP and co-GP and where the LPs are and the different, if you have preferred equity and all that good stuff, how it all kind of trickles down to who's responsible for what. But in terms of what I was speaking about in my presentation, when I say general partner or operator or syndicator, these are all, I'm using them as generalizations to say, this is the team who is finding the deal, underwriting the deal, putting the legal docs together with their team of attorneys, who's raising the capital, and that's a generalization. Ashcroft has, as one example, has a lot of different employees doing a lot of different layers and levels of all of this stuff. But I've also invested with groups where there's one general partner and he or she does it all. They raise all the capital, they find the deal, they underwrite, and they work with an attorney to do docs. So verbally, if you can, visually is better. That's the best answer I can give you.
Oh, yeah, that makes sense. It's just, okay, that makes sense. Because again, I was talking to somebody today telling them that my main function is I find the deals, I do all the negotiating, I raise all the money from the equity investors, and then I work with an operator to fulfill the business plan. And I found I had to go ahead, like I found like maybe for that person, I was having a hard time getting them to understand what an operator did. So like,
yeah.
I told them, like, I told them like when we think about it, like a property management company is, as an example, somebody who's going to go ahead and take care of the day-to-day.
Yes. Right. And then the asset management is overseeing the property managers and
exactly
the contractors and whatnot. So again, I mean, sometimes that gets confusing and you get kind of in a rabbit hole there, verbally speaking, but find a visual. By the way, I don't think this PDF guide that's up on the screen has that particular visual in it, but it does have a lot of, industry terminology and things like that. If nothing else, think about creating a PDF guide for your potential investors that can show them some of this from a high level.
That's what I'm thinking. And I think if I can, just one more quick question. What do you prefer, 506Bs or 506Cs? Because I'm starting to, just because when I find things, I kind of want to move quicker. I'm thinking of taking on the extra work of a 506C.
Gotcha. So for those listening that may not be familiar, so 506B as in boy means that you're raising capital from accredited investors, and if you so choose, also from sophisticated investors, where you can allow up to 35 non-accredited investors in a deal, given that they have a pre-existing relationship with you, they're friends, their family, you've known them, about them, all that good stuff. So that's the biggest benefit, is being able to reach out to your own personal network and folks that may not otherwise be accredited and raise capital that way in a legal manner. Now, what the SEC says about that is, okay, if you're going to do that, then you can't generally advertise your deal. Don't put it on Facebook and LinkedIn and on your website and all over the web. You can't do that if you're doing a 506B. So then that limits you on who sees your opportunities, right? Now you have to get out there and network and get to know people. A 506C can be generally advertised, which is what Ashcroft Capital does. So you go to their website, you'll see active deals. You might be emailed a deal. There might be an ad somewhere on Bigger Pockets or something where you see an Ashcroft deal. That's legal because we can only take accredited investors, no exceptions, and they have to be third-party verified by a CPA, a broker-dealer, an attorney, or a third-party service like verifyinvestor.com as one example. So to answer your question, that was a long-winded explanation, but I think 506Cs are great once you have momentum built. When people can recognize your name, when you have a reputation, you have a track record, and now you have returning investors that like you and what you do. You've got some momentum. Now, why not put it out to the world, so to speak, and get even more investors? It's kind of like a compounding effect. 506Bs usually the best, not always, usually the best when you're first getting started. But not to say that very experienced operators aren't using 506B today, because they are. It just kind of depends on if you want to take that approach of generally advertising or not.
Got it. Thanks.
You bet.
Do you prefer garden style or tower, like apartment buildings, in the event you pick the apartment buildings asset class?
Mm-hmm. A lot of garden style, but that's one piece of criteria I'm just not that picky on. To me, it depends a lot more about, is this particular operator, is this really what they buy a lot of? Do they really understand garden style assets and the things that can go wrong with them and how to repair them? Do they have a lot of that in their portfolio? Have they been successful investing in those? That's what I care about a lot more than me myself, because truthfully, at the end of the day, it's kind of funny. A couple of weeks ago, I was listening to Robert Kiyosaki, Rich Dad Poor Dad author, speak about real estate. And he says, you know, you guys, I'm really not a real estate guy. And that baffled a lot of people. And he said, here's the thing. I get to use debt. I get to use leverage. I get amazing tax advantages from it. And I can create, you know, quote unquote, infinite returns by refinancing, getting my capital back. He said, it's really about what I'm able to do legally and with the tax code. If they were to take those same elements, those same advantages and move it to something else, he said, I'd go invest in that. And if all the advantages went away from real estate, I'd quit investing in real estate. So that's kind of my approach too. It's that, there's a lot of advantages, in my opinion, over certain sectors and asset classes and business models and things. And so I try to just stick with that. And in 10 years, this whole thing could change. You know, if cash flow on multifamily is 2%, well, guess what? I'm not investing in multifamily. You know, I'm going to go invest in muni bonds or something. So anyway, if that answers your question.
One quick question. You seem like, I mean, you're out there looking at deals now. I understand doing B class relative to C class. There's a correlation there regarding, you know, the eviction moratorium and rent collections. Mm-hmm. I think I would probably stay away from C class, but the point being is that these, I mean, we have until like, I think December, like, or it could be extended out. Mm-hmm. How do you think it's going to impact your underwriting? I mean, it does on the debt side.
Yeah. Yeah, no, it's a great question. So these are all, so we have so many unknowns right now. Obviously COVID, the eviction moratorium that you put out, what is the Fed going to do? Where are interest rates going to head? What kind of stimulus is going to come out to people, if any? There's so many of these things, the unemployment benefits. So there's a lot of these things that are completely out of their control. The best answer I can give is, again, working with an experienced operator, which in hindsight, none of them have really been here, right, in 2020, but they have been through a lot, and especially those who have been through downturns in one way or another. That's going to increase, you know, your likelihood to invest in a good asset moving forward. Now, to your question about the eviction moratorium, they've made it very difficult, in fact, to qualify for that for residents. I mean, you have to claim a lot of different things. There's, you know, you're taking basically an oath when you're filling out this stuff. Let me share this really quick. I was quite concerned with this, as everybody was when it first came out. That being said, I invest mostly in B class, to your point. I do invest in C class. I've got probably, I don't know, 4 assets in the C class sector. The C's taken a little more of a hit. That's likely just demographics. And so in income levels and everything else, entry-level jobs, that kind of stuff have been impacted a lot more than other types of work. But here's kind of the high-level stats for you. Let's back up to January 2020. My portfolio was roughly the same allocation. Let's say we had 95% occupancy and 95% collections, just on an average deal with an average operator, B or C class. The Bs are now around 91, 92% occupancy and 89 to 93% collections, somewhere in that range. So everybody took a hit, but it's not a massive hit when we're thinking about our break-even occupancy being maybe 60% or 65% or something like that. So we're not in the scary zone yet. Hopefully we won't get there. In the C class, dip just a little harder than that. So we might be at like 89% occupancy and maybe, you know, whatever, I don't know, 87% collections or something like that. So we're still profitable, still receiving distributions on all of my projects across 14 different operators in both of those classes. But to your point, nobody knows.
I mean, after cutting in here, what's the geography on those assets?
A lot of Texas and a lot of Florida, some Colorado, some Ohio, some Michigan, some Arizona, and one Georgia. Yeah, roughly. I mean, there's probably more, but roughly that. Yeah.
Thanks.
Cool. Yeah, you bet.
All right. So I think we are running out of time. So if you guys have any more questions, feel free to reach out to Travis at Bigger Pockets, LinkedIn, YouTube. Also, make sure to check his PDF guide as well. So thank you so much. That was really, really useful. I learned so much myself. That was really good. Thanks, Travis. Appreciate it.
Thank you, everybody. Thank you for the questions. And yeah, happy to be a resource for anybody. Appreciate it.